We are Da Vinci Consulting. We're excited to be presenting to you today the Executive Committee and Board of Directors of Draxis Health, Inc. We have a couple of recommendations we'd like to make to address the crises that you've identified for us. But first, we're going to take a look at Draxis overall and provide an overview of the company's operations. Primarily, Draxis is divided into two main business units. The first is the contract manufacturing unit, and the second is the radiopharmaceuticals unit. Contract manufacturing essentially acts as a third-party manufacturer for some of the largest pharmaceutical companies in the world, and the radiopharmaceuticals unit develops and markets their own products and equipment in the radiopharmaceutical industry. So the crises that were presented for us today deal with two main ideas: a large foreign currency transaction and the associated currency risks, and second is a possible buyout from a private equity firm. So we're going to begin with the first crisis, the foreign currency transaction. And when we looked at Draxis's revenue and costs as divided between the two regions, the United States and Canada, we realized that there was a strong imbalance. I will point out one rather odd thing about the firm in that although they report all of their earnings in US dollars, they actually operate and maintain all of their cash and cash equivalents in Canadian dollars. And so as a result, you'll see a lot of US dollar figures up here, but we're treating the firm as fundamentally a Canadian company using Canadian cash. And so we can see on this graph that there's roughly a 50-50 split between revenues coming from Canada and the United States. However, as a result of our Kirkland manufacturing facility being located in Quebec, and as a result of the fact that this is our only manufacturing facility, all of our expenses, or nearly all of our expenses, occur in Canada. When we roll this forward into the future, and we're looking at 2009 here, we realize that this imbalance actually gets worse. We've considered the growth in revenue and the growth in costs over time, and we've also added the effect of this new 20-year contract to our revenue. And we realize that the proportion of revenue coming from Canada drops to 43%, and the proportion of revenue coming from the United States rises to 57%. We also note that our expenses remain entirely in Canada. We haven't introduced any new manufacturing capacity outside of Kirkland. As a result, there is an even greater need, given this new contract, to mitigate the risks associated with currency exchange rates. So how exactly can we do that? We're going to examine it from a short-term and a long-term perspective. The short-term perspective centers on using forward contracts to hedge the currency exposure that we see in the cash flows coming from our revenue opportunities. The long-term aspect deals with how do we structure the activities of the firm and the financing of the firm to actually regain that currency balance so that we no longer need to make forward contract hedging. The short-term mitigation strategy makes use of futures contracts, as I mentioned, to hedge our currency risk in the 2 to 3 year time horizon. Just as a quick primer, a futures contract is an agreement to buy or sell an asset for a certain price at a certain point in the future. And the asset we're interested in this particular case is Canadian dollars. It's important to differentiate our strategy here between speculation and hedging. Draxis is not interested in making a bet on whether or not the Canadian currency will appreciate or depreciate over time. Rather, Draxis is interested in eliminating the volatility and uncertainty associated with the imbalance in its revenues and cash flows. So the way we're going to consider this new hedge is to take a look at first the size. The cash flows associated with the new $120 million contract turn out to be about $6 million per year. It's a contract spread over 20 years. In order to hedge $6 million per year starting in 2009, a long position of roughly 60 futures contracts could be acquired on the Chicago Mercantile Exchange. In order to hedge all of Draxis's US revenues, we could acquire a long position of 450 futures contracts on the Chicago Mercantile Exchange. The length of a hedge is something that we also want to consider, and by length we mean the length in time. The futures contracts would need to be selected in such a way as to expire at a period in time relatively close to the occurrence of the spot cash flow. However, we have a risk factor here. Futures contracts that extend beyond 3 years do not suffer from unfavorable point spreads and relatively low liquidity, and this increases the cost of setting up the hedge, which brings me to the final point. Draxis will have to pay to set up these hedges and eliminate this uncertainty. And the payments that will come out in the form of the point spreads they will suffer on the currency exchange rates, as well as some relatively small transaction costs. As a result of this, Draxis must consider the cost of the volatility on their balance sheet and on their forecasting in determining the right cost-benefit point to set up the hedge and to determine the degree to which they want to hedge these cash flows.
As Vivek already mentioned, we've also considered long-term mitigation considerations as well. In the long term, Draxis should aim to rebalance its currency exchange such that it's moving its costs to the US and perhaps increasing further revenue growth in Canada. We've considered 3 major areas, looking at operating costs, financing costs, and revenues. Starting with the operating costs, we suggest that in the future, if Draxis is considering a plant expansion, they should perhaps consider the US as well for the new manufacturing capacity. What this will give them is CapEx and operating expenses in the US and value of US real assets which are tied to currency, and this will act as hedging. Looking at the financing costs, here what we're considering is taking out new debt in the US dollar. And once again, this is if they're considered to take on more debt in the future. The interest payments become a US expense, and the principal becomes the hedge. And finally, looking at the revenue, we considered expanding the revenues in the current Canadian market by targeting Canadian researchers. This can be done by establishing a sales presence in centers of research and innovation. What is different with the long-term tactics with respect to versus the short-term one is that the long-term ones ultimately change the operating and the financing decisions of the company. As such, we only recommend that the company takes on these considerations when it's aligned with the strategic decisions in the long term. We have also considered some risks. Draxis' long-term mitigation methods carry additional risks which by themselves require mitigation, starting with the expanding to the US. This can create difficulties and expenses in managing multiple facilities for management team. As well, it could lead to increase in overhead costs, and this can be caused by loss of economies of scale versus if they were to expand within Canada. And also, being far from their suppliers, specifically the raw material suppliers of isotopics from Chalk River. Looking at the financing, there's impact, obviously, on the credit risk, but there's also 3 other risks, which is interest risk in Canada, interest risk in US, and then the exchange risk between these 2 countries. So what we recommend here, perhaps, is for them to do a complete cost-benefit analysis and even maybe take on further hedging strategies on this consideration. And finally, expanding Canadian revenues. The major risk here is that it concentrates revenues into a single market and economy. Therefore, Draxis should only consider these methods as a part of natural expansion in capital and operations, and make sure that it's aligned with their long-term strategic goals.
The second crisis that we were asked to evaluate was a private equity bid for Draxis. Now, there are some small nuances in this bid that we want to highlight right away. It's a well-regarded private equity firm that's making the bid. This may imply that that private equity firm has a lower cost of capital than some of their less reputable competitors, and may be then, in turn, able to pay a higher price for our company. A significant premium is being offered on the current stock market price. I'm going to dive into this point a little bit more in another slide. Also, the firm has approached the board with an offer, so this is potentially a friendly takeover, as opposed to the buyer using other avenues to announce the takeover bid. Our current stock price is $3.95. Now, this is significantly lower than the 52-week high of $6.64. Now, what's driving that current low price? Well, first, Hectorol, one of our key drugs, which represented 23% of our contract manufacturing revenues, has declined in volume. Also, we've taken a hit from our customers reducing inventory and orders from us. Lastly, there's currency risk that's affected our business. Now, the key to these impacts is that many of them are short-term in nature. The inventory risk and also the loss of the Hectorol business. Really, that just allows us to increase other products coming in our facility. So while the short-term prospects were a bit disappointing, the long-term growth prospects of the company are still prosperous, and the current stock price might not be reflective of the long-term value of the company. So even a premium on the current stock price may not be satisfactory. We need to clarify what the objectives of the management team and executives are, and board of directors. The objective in this decision is to maximize shareholder value. Now, there's a conflict of interest that we must address. The management team may be hesitant to allow a private equity bid because they're interested in keeping their job in the company and leading it. Equally, the board of directors may also want to continue on in their positions and may have to be resistant to the bid. What's important in this situation is that we are transparent in line with good corporate governance. let's notify the relevant stakeholders, including employees, management, and others that are interested, about the takeover bid and proceed with the process in a transparent manner. Now, there's 3 options that the management team and board must consider. First, support the bid that's been made by the buyer. They can accept the agreement and market it to the institutional investors as a good choice for the company. Next, they could fight the bid and suggest to the institutional investors that the growth of the firm is best left in the hands of current management and that is the best value for our investors. Last, we can create an auction process. This would require us to identify potential other buyers, also consider splitting the businesses into pieces that might be attractive to other acquirers, and ultimately give our shareholders a higher return. Ultimately, the selection criteria for all of these options is how can we maximize our shareholder value through pursuing the best path.
Okay, so one of the things we wanted to look at is we wanted to go through each of these bids and describe out some of the pros and cons of it. So if the first alternative is supporting the bid. And obviously that's going to put cash in the pockets of shareholders very, very quickly, and that's one of the big pros. It's got low cost to implement. However, the biggest con is that it's not necessarily going to give the highest return to the shareholders. We're not sure what else is out there. We're not sure whether this value is actually a good value and whether there are other synergies from other potential acquirers that could lead the value higher. Also, there's potential resistance from other stakeholders, like the employees, regarding a private equity bid. So this might be a reasonable alternative, but we're not sure that the shareholder value is going to be optimized. The second alternative is fighting the bid. The biggest issue here is that the techniques you'd actually use, such as poison pills, are not that effective in Canada. They're not very successful. They haven't been very successful in the past, and we don't expect them to be successful in this case. Also, we've got 44% institutional investors. They've got their own evaluation process, and they're not very likely to be swayed by what the board or the management say themselves. Therefore, we don't think that this is a very strong option. Finally, we've got what we think is the most interesting option, creating a bidding process. By allowing a large number of different people to bid for the company, we're creating additional value, we're allocating additional value for our shareholders. Secondly, we've got a potential to find a better acquirer for the company's stakeholders, such as its employees and the community. However, we're worried about a couple things. Firstly, that the first bidder may exit before an official bid is actually placed. And there's an increased period of uncertainty here because it's a long process from the start to the finish of a bid process. And there's some costs associated with being in an auction process. However, we think that this is the strongest option for maximizing shareholder value overall in the company. So we decided to reject the first 2 options and pursue creating an auction. How does that actually work? We think there are 3 main steps. First, you have to identify potential bidders and market to them. So we're looking at our existing customers, our competitors, other private equity firms, and our current shareholder base, the institutional investors. Those are people who might be interested in acquiring the company. We want to market the company to as many of them as possible and get them to become serious bidders in the process. Secondly, as Richard spoke about before, we're going to raise the possibility of selling individual pieces of the business. We've got 2 very separate businesses in radio, pharmaceuticals, and contract manufacturing. And it might make sense that the synergies associated with those businesses would need to go to different acquirers in order to get the best value. So we're committed to splitting those up if necessary. Finally, we want to establish a deadline and make a commitment to accept the highest bidder. That's going to put more serious bidders on the table and allow them to be committed to the process. We've got a few risks associated with this plan. One of the first risk is that the employees might be demoralized by a long, drawn-out process. They're not sure where their jobs are going to be and where they're going to be in the long run. The biggest question about that is it increases the risk of a quality infraction, which is a very important element quality is a very important element of our business. So we're going to make sure that we communicate extensively with employees about the process and possible outcomes, and increase our quality diligence. Make sure there are more people around and making sure that quality is still paramount at the company. We also spoke about this idea of a bidder retreat, that the bidder that we have right now, once they see an auction process, they might not want to proceed with that process. And we think that if the initial bidder is going to retreat, we think it's because they think there's going to be a higher bid out there. And that's actually good for us at the end of the day, because that higher bid means more money for our shareholders.
So that pretty much sums up our recommendations for the two crises that you encountered, and we'd like to open up the floor to any questions you might have.
Do you have any sense of what price we might get for our company?
So at this point, I don't think it's our responsibility, as the board has to go out and find people in order to make a valuation for the company. We're not really sure where it is right now. In our initial presentation, we created some revenue possibilities that could lead it up into the $20 or $30 a share range, depending on how they turn out. So we think there are large growth opportunities. There's interesting products in the pipeline, and we think the price should be quite a bit higher than it is today.
As I'll give just a small milestone would be if our 52-week high was $6.64, we think that the Q3 hit in stock price was unique, that getting back up to $6 would seem like a reasonable thing that the business can do over the next few quarters.
At the end of the day as well, the board can facilitate getting the best price it can out there. Regardless of what we think, we can use some formulas to kind of figure out where we think the price should be. But at the end of the day, the idea is to get as many bidders into the process, and they're going to dictate what price we can get and how high it can go.
I understand that. I just wanted to know if you had any sense as our advisors as to what we're aiming for.
We've engaged you as a consulting firm to advise the management and the board. Can you be a little bit more specific as to what steps you're recommending this board take with regard to the private equity bid that's being brought forward? I know you went through it, but you seem to have moved off your firm position in your response, and just want to make sure we understand what you're recommending to us. And what would be the difference in actions that you would anticipate from management versus us as a board?
Earlier in the day, we took a good look at the corporate governance in the board, and we actually don't think that there should be much difference between the objectives of the management and the board of directors. Excellent corporate governance at the firm, so we know you're after maximizing shareholder value. Very specifically, on the issue of the private equity bid, our recommendation is to open up an auction process. The first step of that being to approach potential buyers, some of them being our current competitors, which would be Patheon Inc., for example, and a current customer like GlaxoSmithKline or Johnson & Johnson. When we approach them with the business, we have the opportunity of potentially divvying up the business into pieces that fit their portfolio better. But ultimately, the recommendation is to invite other bidders into the process and to increasingly raise the bid until we have a buyer on our deadline that we set.
Can we look at a worst-case scenario that the bidding process doesn't result in a satisfactory offer and that we don't have the ability to do a transaction right now? What steps are you recommending to this board that the company take to maximize shareholder value in the event we don't have a deal?
We'll bring up a slide we have in the appendix about that. Specifically, there's a lot of growth potential for the firm. We saw growth potential in the radiopharmaceutical business in terms of expanding some of our products. We have 2 products very near the end of our pipeline, getting FDA approval. So we had opportunities to sell those products in Europe and further make some sales in North America. On our contract manufacturing side of the business, we talked about increasing our sterile capacity business, which had our revenue projections were to increase on that stream by $50 to $70 million by 2012. With a $25 million capital expenditure. So there are the management at the time currently has some strong growth plans for the company that if a bid is not to go through and follow out, then I'd suggest that the management continue with that strategic plan and plow forward with that.
I just want to ask a follow-on question about the current private equity bid that's on the table. you've indicated because it's a reputable firm with a good reputation in the marketplace, a successful firm, that they may have a lower cost of capital, therefore they may be prepared to pay a premium. On what do you base that?
I think essentially the financing structure of any firm is related to its risks and its ability to generate profit and generate revenue. And private equity firms themselves are no different. I think a private equity firm that has had a long track record of success in its investments and its acquisitions and eventually its divestitures would be able to gain investment in their firm at a relatively lower cost. They would have shareholders and investors in their firm who are staying with the firm for the long term. And as a result, they'll be able to take perhaps more risky bets to put more money into the things that they are interested in. And if they are interested in our firm, they probably would have a greater supply of resources with which to direct to such an acquisition.
Have you had the opportunity to model the private equities, how they would look at it? And what you think this offer that they have on the table now, what you think the returns that they're generating from that?
We didn't actually know what the bid is. So we don't have we just know that it's a premium on the current stock price, so it's somewhere above I think it was $94. I think that.
So you didn't take the opportunity to, make an assumption 20% over and back and try to reverse engineer the private equities model?
No.
Maybe another hour and a half and we would have.
Yeah. What do you think the customer's reaction will be to a sale? And the suppliers too. I mean, radioactive isotopes going, is this some horrible American firm that's coming in here or what?
Well, we think their customers, currently they have great relationship with their customers. And the main concern for them really would be, for whoever the partner is going to be, is one that's going to be able to continue to provide them with the services that our company currently is. And also, maintain quality is really the main issue for them. It's really their core competency, and it's what it's the J&J contract, for example. It was really that they were low risk and the high quality, and that's why they decide to sign them on. So for their customers, the partner should reflect that, and we think the company would probably take that into consideration as well.
I mean, one of the concerns I have as a board member is that, these customers look at us, we've got lots of cash, we're very stable, no financial risk, et cetera, and, these private equity firms come in here and lever it all up, and there's all this debt, and like you hiccup once and the currency moves a penny and it's all over.
Well, it's interesting that you mentioned levering it up. We've actually worked out a debt-to-equity ratio that we believe is optimal for the capital structure of this firm going forward, taking into account the sort of volatility and any sort of risk inherent in the operation of the firm. We do believe that they can optimize their capital structure by taking on some debt. A private equity firm may be interested in doing that. The degree to which they may be interested in doing that, of course, would need to be looked into. Do you want us to walk through this slide?
No, I got it. Thanks.
I think that the major sort of reason behind it, and when we looked at the operations of the firm, when we looked at the operation of the firm, what we realized was that two different divisions are actually relatively independent. They don't have very many operational synergies, and they don't have very many they don't have very much overlap in their activities. So from an operational point of view, they do sort of function independently. But when we looked at the ownership structure, we realized that there was a small advantage to having the two together. And it basically comes down to risk. Each of these divisions is not necessarily large enough to be able to amortize their risk across a large enough product portfolio, a large enough mix of customers, a large enough many different markets. And so as a result of combining these two relatively independent divisions, we are able to sort of lower our overall risk exposure as a firm. And so we believe that that's the value that's being had right now. Obviously, through an acquisition, an acquiring firm that may be in the contract manufacturing space may no longer need the risk protection of, say, the radiopharmaceuticals and may be looking to divest that, so that ownership advantage changes. Questions from the audience?
In dealing with the currency issue, back to the, you had a good approach in terms of looking at both short-term and long-term options, but recognized correctly that there were risks in both and that some of the cost of hedging long-term was going to be high. Did you come up with any thoughts on a hedging ratio at all as to should we hedge everything related to that contract, or should we consider about hedging something less than 100%?
I think when, so you're referring to the short-term hedge then, in terms of the degree of hedge. Yeah, I think that it would probably be, from an overall firm point of view, it would be something less than the total exposure. I think in relation to the contract is, I think it's maybe 8 or 10% of the overall revenues of the firm, probably a little bit less than that. And so I don't think sizing it based on the size of the contract is necessarily the way to go. Overall, though, the firm is well diversified between Canada and the U.S., although its manufacturing and expenses are not. And so a significant portion of that may need to be hedged given the volatility we're seeing in the market.
So of the $120 million of revenue that we have just specifically to that contract, you would suggest we hedge all of it?
Well, the $120 million refers to the total revenue over 20 years, so it's actually a $6 million per year contract, which is relatively small given the revenue of the firm. And so I think that the hedging decision would be made firm-wide, looking at all the revenues and all of the, in both regions. And so I think we would probably establish through some further analysis a hedge ratio for the entire firm for their revenues going forward.
I'm still puzzled. You mentioned there are two components of the firm that don't have much synergy that could be considered separately. I still haven't heard from you what you consider to be the minimum fair value for each component. And at which point should we just walk from a bid? What is your value for the radiopharmaceutical side of the firm? What is your value for the contract manufacturing side as a minimum acceptable bid to us?
We don't have a full valuation. We do have a couple of growth initiatives. I don't know how long it's going to take me to go through that. But we valued a couple of the growth initiatives that we proposed, and we actually realized that there's significant amounts of growth in these markets as they expand into Europe and as they develop a couple of their other products. I'm going to try and find this. Couple more. There you go. There it is. And so we took sort of a present value analysis of all of these ventures. There's obviously risk associated with this, and so it would need to be adjusted. But this is sort of what the opportunity is in terms of revenue prospects in a sort of current capitalization outlook. And so this gets us, upwards of $800 million of new market capitalization. And so this would sort of be fed into a risk-adjusted analysis of the valuation of the two different divisions.
Well, I'm concerned that there may not be growth. I'm concerned, as I read the newspapers, that consumers may be very reluctant to submit to investigations with radio tracers and may wish to have magnetic resonance imaging or CT scanning or echocardiography. And I'm concerned that this whole area of nuclear imaging will actually decline in patient acceptance and in volumes. So shouldn't we just sell that portion of the firm now and avoid that risk?
Well, there's two things that I would suggest to that, and the first is that the patient groups that you're looking at are tumor patients. They're individuals who are often undergoing chemotherapy or often radiation therapy, and so this is to a certain extent a self-selected group who already have a medical need for this kind of diagnostic imaging and who may also be undergoing therapeutic level radiation exposure. We also identified sort of a sales per capita kind of ratio in the United States and in Europe. We would expect sales per capita to be roughly equivalent in both regions of the world. And so we identified that as the growth potential in Europe as this procedure and as as the firm's prevalence takes on there.
Well, the majority of the sestimibia in the U.S. is for elective tests where there are alternatives, and the alternatives don't require radio tracers. So I'm concerned that perhaps the growth estimates are too optimistic and we should sell that. So if we do, what value should be put on that part of the company?
I think you can go back to the NPV, and then we've basically valued the business.
We don't have a valuation for that piece of the business. Our idea is to go to buyers, and when we approach them, that'll be sort of our process, given the analysis that we've done. We don't have a number that we'd be willing to sell at them, but we'd sort of put it out on the market, and the market would, with a number of bidders, be able to tell us what a price for that company is, or what the market views as the future growth of that business. So we have some growth projections. There might be some errors in that, and I think when we put it out to bid, some of those errors get washed out by having a number of bidders with different ideas of their projections. So there is no specific number, but if we put it to the market, we think that'll be sorted out, and we sell to the highest bidder.